disclaimer first. I am not a financial and investment advisor. This video is only for educational, informational, and entertainment purpose only. So, in this video, I will present you the portfolio that I created. I guess using different portfolio weighting schemes. Now, even though the title of this video is leverage all-weather portfolio, I didn't really directly use the risk parity portfolio weighting scheme. I actually use a different, like a little bit more sophisticated method that does minimize the portfolio's like maximum drawdown and conditional value at risk. And the main reason I chose this portfolio weighting scheme is because I'm here to find a portfolio that is less volatile, so that I could employ some leverage without getting a margin call. When you actually go live. So that is the main reason why I choose a different portfolio weighting scheme. So, okay, going back to this, the backtest parameter that I use here is from January 2007 up to October 2020 this year, and the initial balance that I selected here is like around 10,000 US dollars. And our rebalancing method here is annual rebalancing, so we could reduce the transaction costs. Okay, and I reinvest the dividend here, so every time we get a new payment from the underlying or from our holding, we reinvest it quickly in the next rebalancing. And I compare this portfolio to the SPY ETF, and since I'm gonna compare the ×1 leverage versus the ×4 leverage, I have to pay around 2% per annum for that borrowed money. So again, for this backtest, I will make some assumptions here that there is no margin call. So even if I did suffer like a some large drawdown, I guess I'm not gonna get margin call. So just put this in mind. Okay, and that slippage is not considered, although you shouldn't affect the overall return because we're actually a long-term investor here. And I use 4 times leverage, or 4 times leverage is allowed, okay, from your broker or your broker's partner banks. So if you look at here, you could actually see the individual performance of the underlying, which if we could go back in this slide, I chose IAU for gold just to get exposure for gold, and then Invesco Dynamics Offer ETF to get exposure for equity. For an all-weather portfolio, if you really want like some kind of explosive growth in your portfolio, then you have to choose equity. So this is the equity that I've chosen, which is PSJ. And then I chose mid-term to long-term, kind of like a treasury bonds in the US. So the 7 to 10 year treasury and 10 to 20 year treasury. Okay. So again, this is the individual performance. You could think of each ETF of this as a strategy. It's in fact, it's you have to think of it as if you're investing in an algorithmic trading system. Okay, so that's how I see an ETF. I see an ETF as a strategy. And what we're essentially trying to do here is we're building a multi-strategy portfolio or a multi-system portfolio. Okay, now in this slide, we can see the growth of our portfolio. You could see in this graph, it's in log scale. So for the 1 times leverage portfolio, it's actually a lot smoother in here. Yeah, so I guess in more than a decade we did manage to double or close to doubling it. We didn't really double the money. So from starting from $10,000 up to 20. Oh, we did double it, or yeah, doubled and tripled actually, up to 30,000 or more than 30K, but not close to but close to 40, but didn't go beyond. So again, as you can see, the blue line here, the 1x leverage is actually quite smooth. Using that portfolio weighting scheme that I mentioned that minimizes the CVAR, or the conditional value at risk, and the maximum drawdown. So I will explain that in the future video, what that performance metric is. That CVAR, which is really important when assessing I guess, the performance of your strategy or portfolio. And in the red line, you could actually see the performance when I actually use leverage in here. As you can see, it's actually multiplied by several times. Okay, this is extremely good. Now, if we look at 2008, where we actually suffered like some like big drawdown here, I guess, relative to the previous high watermark. So as you can see here, this drawdown might well, if you're borrowing money, this drawdown might trigger a margin call. So if you're gonna employ this strategy, just be mindful, and you have to monitor it constantly. Okay, so you know what, I take away what I let me take what I said a while ago, and I should say that you should constantly or actively monitor this portfolio because of that potential margin call from like big drawdowns. When there's like a let's say a monthly or daily return that goes beyond your, let's say, VAR 95, and the return goes to your left tail of the went beyond the VAR 95 in the left tail of your portfolio returns. So as you will see later, this might actually cause like a big drawdown, or sorry, a margin call. So looking at this one, so our portfolio return, 1x leverage. So for the unlevered portfolio, this is like, I guess, compounding on an annual rate, like around annual rate of around like 9%. That is extremely good. In fact, you could actually make a lot if just even without using leverage. But of course, I think this is a common technique in quant finance, is that once you've found like a really smooth equity curve for a multi-strategy portfolio, you have to learn how to lever it up to literally extract the returns from the market. And this is actually like a good example of it. Although in practice, I would be a bit more concerned about like this kind of event though, when the return goes beyond, let's say, around, I don't know, more than 2 sigma. That is pretty scary. And look at this one, the standard deviation. In one so annual standard deviation of this is like around 23%. So that's actually pretty big. That's actually more than our the benchmark. But hey, if you're like the risk taker, then you could actually do this type of portfolio, employ this type of portfolio and just monitor it now. And make sure you don't go beyond this in the downside. So as you can see here, the maximum drawdown is 30%, but then our Sharpe ratio is 1.10, which is really good. And what's funny here is we have like a lower correlation against the US stock market. But that is extremely good. So here you can see the trailing return. Not much to see there. So okay, now let's look at the performance metric. So for the 4x leverage, you could actually see that it can give like a average of like around 2.24% monthly, so which is a bit more realistic. Any good fund can give a return, an average monthly return of like around in between 1% or slightly less up to um, potentially 5. I think 5 is extremely good, but it's gonna be difficult to achieve without using leverage. But those are the really good ones. And so yeah, so this is actually what I'm talking about. So for the 1 times leverage, it actually can give you like around an average of like 0.75% monthly. But when you annualize it, this is actually going to be a lot bigger. So this is like your expected return. Okay, it's like around 30 point like 39%. Just remember that the expected return is actually different from the compound annual growth rate. So yeah, you can see the volatility, the maximum drawdown, but I think more interesting performance metric in here is the beta. So if you look at this, is all of them so the 1 times leverage and the 4 times leverage are below 1, which is good. So we're not as volatile, and we're not extremely correlated with the the market or the underlying benchmark here. So which is good. This is see, this beta right here is just the representation of the market risk, which is a better metric uh, to measure I guess risk compared to just the volatility alone, because beta bakes in both the volatility and the correlation compared to the benchmark or the market here. So moving on, I think another interesting thing here is the conditional value at risk. So var 95 or the CVAR 95. So I guess in this one, on average, in the worst 5%, like how much? What is the average loss that we can expect, or kind of like the drawdown, I guess. Well, in the, or down in the portfolio value. So in the 1 times leverage, we could actually expect to kind of like lose more or less around 3.77% for the 1 times leverage, and then it's gonna get magnified by quite a lot with 4 times leverage here, so around 13% on average. Okay. And moving on, so you can see the annual return here. This is pretty good. It's actually giving, well, we didn't really suffer a big down year here, except for 2013, where we actually lost just 0.38%. But if you look at this year, it actually did made a return of like 53%. It's really big. Yeah. But year on year, it actually gives you a return. We could, capture it. So this is what I'm talking about a while ago. So yeah, again, for this backtest, we didn't really, or I made the assumption that like we're not gonna have any margin call. But in reality, just be careful that when you actually employ this type of portfolio or leverage portfolio, you have to monitor it carefully, because you might actually suffer like some kind of like big drawdown here. So when your portfolio start losing a certain amount of value, let's say in this case like around 30% drawdown, okay, so when you go beyond your maintenance margin here, you might get a margin call from your broker, and they might liquidate all of them. So just be careful with it, and always monitor your positions and what's happening. Although of course, like you just have to look and then just decide whether or not to liquidate all your position before the broker does. So build your own objective rule. Maybe, maybe instead of just like the annual rebalancing, you could consider a rebalance logic based on the drawdown. So let's say when we're already suffering like more than around 15%, then that's the time we liquidate and maybe rebalance the whole portfolio. So I guess few decision. One is either just stay or rebalance, or just stay out of the market. When we're in a when we're in a, I guess, a recession or something similar to it. Although in the 2020 coronavirus, we didn't really suffer much, relative to the previous high watermark. So just this is the only one. Then what's the average here? I guess looking at CVAR again, I think it's like around 13%, right? CVAR is like around this one. The worst 5% we could actually suffer on average, if we calculate here, is just around 13%. That's still dangerous now. So yeah. So again, this is the leverage all-weather portfolio. I hope you learned something here, and if you're gonna use leverage, just be careful with it. All right, thanks for watching. See you in the next video.